Good afternoon, folks. It's John with the Baptiste Realty Group. Today, we got a special guest for you. We've got Becky Reuter from Providence Bank, and Becky's going to talk to us about the mortgage process when it comes to buying a home. First of all, Becky, welcome. Thank you for taking the time to be with us today. Why don't you, I'll let you talk about yourself in the bank and just give us a little introduction to who you are and what you guys do.
Thanks, John, for having me today. Like you said, my name is Becky Reuter, and I am the market manager here in Texas. We're located in Grapevine, Texas. We're actually Premier Bank of Texas in Texas, where our main branch is in Missouri and Illinois as Providence Bank. But long story short, since there's already a Providence Bank here in Texas, we had to stay with Premier Bank of Texas. So that's where we sometimes see the joint marketing between the two names. But we have been in business for over 100 years. The mortgage company down here was brought about 4 years ago. And it's very exciting. I'm excited to be leading that way. We've grown quite a bit. We've got 2 loan officers that work for me now. We've got processors and underwriters, closers. We've got the whole deal. So it's a legitimate mortgage company within the bank. It allows us to do portfolio loans and construction loans and lot and land loans, which is really nice versus like a normal mortgage company or even a big box bank like US Bank or Chase or Bank of America.
Oh, okay. Well, that's definitely good to know. Well, let me ask you this real quick. You talked about the big box banks. You know, as a realtor, we often talk to our clients about the advantages of using, smaller local banks. Using you guys, is that also an advantage? I know that you're elsewhere, but sometimes we have those issues with the Chase banks of the world. So
yeah, I spent a lot of my career working for Bank of America. So yeah, I would choose a small community bank like us any day, hands down. Even getting my own mortgage, I wouldn't go through a big bank if I didn't work here. You're a number to them. And if your closing date is November 23rd and they've got 100 other closings that day, you're probably not going to get lucky enough to get yours closed on time just because how are you going to differentiate yourself, or even how are you going to get a hold of anybody with an 800 number?
Right.
So, here, we have a local bank branch. If you can't get a hold of me for some crazy reason, you can call the bank branch. You can get a hold of my manager. I mean, it's just so much easier to get a hold of somebody at a community local bank than it is a big box bank.
Absolutely. Absolutely. So folks, you're hearing it from the lender themselves. When we tell you guys, we really don't want you to work with Chase.
Yeah.
Yeah. So that is the issue, that as a borrower, you are a number. And when we're looking to get something done after hours, there's no support. But if we call Becky, Becky's going to answer the phone, or somebody's going to answer the phone.
That's right. And then another big deal with community banks versus a big box bank or even a mortgage company is if something happens, let's say husband and wife have applied for a loan and for some reason wife loses her job, so your debt ratio is higher than maybe what secondary market will allow, or there's some extenuating circumstance, or maybe your situation just doesn't fit into a normal secondary market box. But we don't find out about that until we're already in the process and maybe 10 days from closing. We have the opportunity to keep that on our portfolio, which is a huge deal because that means for not only the borrower, but for you as a real estate agent, you save that deal that you're going to close.
Right.
So, with a big box bank, when you're just a number, you really think they're going to cry at night because they said no to you? No, they're not.
Not at all.
They're not going to lose 1 wink of sleep for that at all. But I will. I mean, knock on wood, I haven't had a deal that has gone astray like that at all, that we haven't been able to save or figure out from the beginning that it's just not going to work. But I lose sleep all the night over my borrowers and my agents. I mean, I become personal friends with a lot of them. And so I, take it to heart if something happens to them.
All right, you buyers out there, you hear what Becky's saying. This is what we go through. You guys think it's all easy. I mean, we go through a lot to get you into a home. Losing
Yes,
sleep is one of those things.
yes, and crying, even though there's no crying
Yeah,
in
I've seen
mortgage.
that. I've seen that definitely.
Yeah, yeah.
Well, I've got a question that comes up a lot. You know, when we hear from potential borrowers, they'll say, "Well, I got pre-qualified," or someone will say, "I got pre-approved." What's the difference?
Well, there's pre-qualified and pre-approved. So pre-qualified really just means that you've called somebody and said, "Hey, I think my credit score is this, and this is how much I have down. Would I be able to get a mortgage with that?" Well, it's easy to say yes or no with those figures, but unless I have your credit pulled and I've seen your pay stubs, bank statements, tax returns, and all the above, I would not write you a pre-approval letter, because I don't want to set you up for failure. So I don't want it to come
Right,
back. I thought your credit score was 740, but maybe you didn't know that somebody stole your identity, or maybe you forgot that you had a credit card and it has 120 days late because you didn't realize you had it or something. I don't know. There's so many crazy things that could happen. And now all of a sudden your score is 640 or even below 620, and now you can't even get a loan. But here you've already made an offer and it's been accepted. Puts you in a really bad position if you are not actually pre-approved in a lender. You've actually has not physically talked to a lender.
okay. So then it's best for the borrower to look for that pre-approval before
Mm-hmm.
they actually go out and spend their time. It's not even about my time, but spend their time looking at
Right.
something, getting their hopes up, and then finding out later that they can't afford it.
That's right.
Okay.
Yeah. Yeah. There's a lot, self-employment income has come down really hard with the regulations from COVID. It changes almost every day. So especially if you're a self-employed borrower, definitely have a lender look at your tax returns, business and personal, and make sure that you can still qualify, because lending has gotten really tight on that.
Okay. And
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 even
that
people that have lost jobs, and now are coming back in, maybe they're an hourly person and they lost their job and they worked for Target or something, and now they're coming back and they're working for something that's completely in a different line of work. You could have trouble qualifying then because you don't have a history of hourly wages.
right, right. Okay. I get it. Well, and that brings up something that I guess we're all living through history as it is with COVID. How, besides the regulations, how has that affected, you guys' ability to get borrowers pre-approved, or has it at all?
The only problem that I've had is just that the low rates have increased my business by, I'd say, 200%. I mean, it's crazy. We're having some of the best months that we've ever had as lenders. So really, that's all that COVID has done, and keeping up with the guidelines. It's my underwriter will send an email almost every day that something has changed. There for a while, it's slowed down now a little bit, but there for a while it was crazy. Like, I've been in the business for about 20 years, and I was even second guessing myself, like, can we really do this? And you got to make sure that you have a lender that is following, or staying up to date with all the changes, and not just, well, this is the way we've always done it, because that
Right,
can get you in a lot of trouble.
right. I get it. Okay. Well, that's good to hear that you guys are doing well. That means people are still employed,
Yeah, yeah,
and we're surviving. We're surviving. That's
yeah.
until we can get through this. Okay. Well, there's a question that comes up as well, for the average borrower, and I know that's kind of broad in saying the average borrower, but say a person is looking for our price, which is average 250. Okay. How much does that person typically have to bring as a down payment?
Well, there's several options for people these days. So we still have the 97% financing, so they would only need 3% down as conventional.
Oh, okay.
So that's Home Ready, Home Possible, and then Freddie Mac has a Home One product. And you can be a homeowner previously But for the home one, and there's no income limitations on the home one either. So home ready and home possible have income limitations. Home one does not. But you have to be a first-time home buyer within 3 years. So you can't have owned a home within the past 3 years for those programs. Otherwise, you go down to 5%, and that there's no income limitations. There's no first-time home buyer requirements or anything for 5% down.
Wow, that's pretty good. I mean, and for you folks out there listening that are paying $1,500, $2,000, $2,500 in rent for apartments, I mean, 3% down on a home. I mean, that's pretty amazing. So to get the opportunity to build that equity and to actually not just pay for your landlord's kids to go to college. I mean,
right. Yes. Yes.
Okay. Now, another thing with the 3% down, if I'm not mistaken, that person then would have private mortgage insurance.
That's correct. Yes.
Now,
yes.
what is the purpose of that?
Well, it's actually an insurance policy that is you pay for the lender to guarantee or to, if you default on your mortgage, that we would get our money back. So I kind of, if you're familiar with gap insurance kind of for vehicles, it's kind of like that, but you as the borrower have to pay it for the lender.
Okay. Is that required?
If you are over 80% loan to value, or basically you have put down less than 20%, you are required to have mortgage insurance. Yes.
Oh, okay. Okay. So is there a point in, I'm getting a 3% mortgage. Is there some point in time where I can cancel that private mortgage insurance?
Yeah, you can. And I will first say that there's tiers to that too. So, like from 80.01% to 84.99%, you have different tiers of coverage. And it also, the premium is based off of different factors, credit score. I think it's helped if you've owned a home before and have repayment history on your credit report of that type of stuff. So the better credit, you'll have a lower premium than you will if you have worse credit. And the home ready and home possible loans, they also offer a lower mortgage insurance. Like it's almost 0.5% of what standard is if you go through one of those programs. So that helps a lot.
Okay.
Yeah. To answer your question for canceling, hold on one second. Sorry, I had a phone call and it took me away from you. I've never had that happen.
We're doing business here, folks. Everybody's doing business.
Yeah. So it will automatically, there's different mortgage companies. So Genworth, MGIC are a couple of the ones that we use. And typically it'll automatically fall off when you're at 78% loan to value. And when you close, you'll get your amortization schedule and your mortgage insurance information to tell you all the details of that. But that's but let's say that you won the lottery or you got a bunch of money somehow and you made a principal payment that got you down to that 80% loan to value. You can call whoever's servicing your loan. So a lot of people, and us included, we sell the servicing rights to our loans we use US Bank or Freddie Mac directly, or somebody that's like that is who you'll be making your payments to, which is the norm these days. So you would call them and see what their requirements are. A lot of them that I've had in the past, you pay $500 and they do some type of appraisal or have an appraisal done, and then you can have it taken off.
Oh, okay.
It's not very difficult at all.
Okay. Well, I mean, that's good to know. I mean, at a certain point, it comes off automatically. But like you said, if there's a large windfall, that they can save a few bucks on their mortgage by having it removed as well. Right.
And the FHA loan, that is 3.5% down. We didn't talk about that one when you asked about loan programs, but it is mortgage insurance for the life of the loan. So it doesn't matter if you have 10% loan to value, you're still paying mortgage insurance on that. So if you're, I honestly try to steer people away from FHA loans just because we have the conventional loans that allow 3% down instead of 3.5%. So it typically works out better for them to be into that conventional loan.
Okay. Well, that brings up another question. Like, really, what's the difference between an FHA loan and conventional?
Well, the FHA loan is the government-backed loan. It's kind of similar to the VA loan and USDA loan. Those are the government-backed programs.
Okay.
So, you know, you have stricter appraisal requirements. So the appraisers are going to check for safety conditions as well as the valuers conventional. They're only going to make a statement if it's some major like structural or there's walls missing or, you know, something crazy. But FHA and VA and them will like check the height of chair or handrails and
Wow.
rotting wood and on like around the windows and stuff would all have to be replaced before closing. So in older homes, it can get troublesome for both buyer and seller to resolve those problems. But the VA loan is a great loan. If you're a veteran and you qualify for that, I would 100% use that loan. FHA, if they do allow for, you don't really get a hit to the rate for a lower credit score like you do with conventional. So, you know, it's a case by case basis when it comes to that.
Okay. Well, I mean, it's good to know that people have a variety of options. So I guess that's the good point. Well, that leaves me thinking about one thing that people don't often take into account in their mortgage payment is they think or they see advertisements and they're talking about principal and interest, but they often forget about taxes and insurance. Is that something that's combined? So when a person pays their monthly mortgage, does it all go together or do they pay it separately? How does that work?
No, so that's considered their escrow account. So it's
Okay.
basically a non-interest bearing account that the lending servicer holds for you. You pay into it monthly. And when those items come due, like your homeowner's insurance due, it'll be paid out, and same with taxes. So you don't have to worry about paying those when they come due because you're paying into your escrow account each month to pay those premiums.
Okay. So then
So,
no worries about forgetting to pay the insurance or the taxes because you guys are going to take care of it for them.
right. Yeah. And you can select who you want to use for homeowners insurance. We don't select that for. Obviously, taxes are paid to the county and state or whatever, you know, whoever gets those. Seems like everybody's getting taxes these days from me.
Yeah.
Yeah, so when those come due, if you are under 80% loan to value, you can waive collecting those taxes and insurance monthly if you want to, and you can pay them on.
I would think that could be a dangerous proposition for most people. If you're not a disciplined saver, that could be tricky.
Yeah. There's, you know, a lot of money savvy people, just they want to keep that money until the last possible. I mean, even though accounts really aren't gaining that much interest, it's just paying it on their own makes them, you know, feel like they're in control of their money a little bit more, I believe.
Right. No, I get it.
Those escrow accounts can, you know, taxes here in Texas are extremely high for the property. So
yes, they are. You
can, you know, the principal and interest on like probably a $200,000 loan is, you know, around $1,000, and you add $500, $600, $700 a month for taxes alone. It gets pretty high for the payment.
Yeah.
So you just got to be aware when you're looking at property. That's where, you know, I love working with great real estate agents like yourself. You know, you have that conversation beforehand that says, you know, hey, this borrower's tight on their ratios. We got to make sure that you find a property that the taxes are no more above, you know, $6,000 a year or something like that, so that we're not looking at homes they can't afford.
What? Wait, did you say that we're not looking at homes that they can't? I think the people.
I said.
The people, folks, you're hearing what we say all the time. Just because you see that $1 million home does not mean you can afford it. Let's stay realistic, stay within our budget, because we don't want anyone having to be foreclosed because they couldn't afford to pay for something just to sell a house. We don't want that. So, well, just thinking about one of the things you said earlier, that your business has been going really well because of these low rates. What's your thoughts on, you know, will the rates go up anytime soon? I know you don't have a crystal ball or anything, but just you're in the business. What are people saying as far as when rates may go up, or do you think they can go even lower?
I really don't think they'll go any lower. I mean, the 15-year rates are right around 2%. 30-year rates are at 2.5, maybe a little bit lower some days. So,
Wow.
yeah, I mean, that's it. It's just incredible. Those are incredible rates. And if you're not happy with those rates, then I don't know. I think that the rates will stay low through the first part of next year. Obviously, we have an election coming up in a few days, weeks, I guess it is now. And depending on the outcome of that, it could go either way, honestly. So,
Right. Well, my own hypothesis on the rates are that they've been so low that I think it would be a shock to our economy if someone tried to just raise them dramatically. And I know the Fed likes to do it in increments anyway, but
mm-hmm.
people are really addicted to low rates right now. And it's hard to get people off of something like that.
You're absolutely right. Yeah. Yeah. I mean, I've been in lending where they were at, 10%. And, it's life still goes on. I mean, if the rates
Right.
go up, I'm not that worried about it. People still have to buy homes. They still have to sell homes. So, the rate is what it's going to be. And yeah, you can't hold out because you think you're going to get 2% again if the rates were to go up. It's
Right.
just, us as the real estate industry is going to have to do a lot of teaching to the communities and just say, you can't let a higher interest rate than 2% stop you from owning a home.
Exactly. Because
If the interest rates are going to go up, then probably so are rent amounts. So we're still going to be in the same equation there where, if you're paying $2,000 a month for rent, well, you may be, whereas now you're in a 3-bedroom, 2-bath home, there you might be in a 1-bedroom studio for $2,000. And now
right.
the 3-bedroom, 2-bath are $4,000 because the rates have gone up. So it's all in relation to the scenario.
Right. Exactly. And at these low rates, folks, if you can afford to buy, I mean, you're going to be able to get more house than you would have even last year. I mean, so now is the time. Would you agree, Becky? Now is the time to act. We just can't wait because none of us have that crystal ball to say whether they'll go up, they'll go down. Now is the time.
Yes, absolutely. I've been saying that since the spring when the rates really started going down. That, I mean, I haven't done the math on it, and maybe you've heard, but just how many more thousands that you can purchase because the rates have gone down. I mean, whatever 1% changes, it can be quite a bit on a higher mortgage.
Right. Especially, yeah, if you're when you're talking, say that what we specialize in, the move up buyer from, your first home to now you've got to get a bigger home because you've got 2 children instead of 0, and you're looking at that next home and if you're looking at new construction, everything is pretty much over 300,000 that you really want. So
Yeah,
300 to 400,000 at 2.5%. I mean, that's a big difference from even 3% can make a
you're
difference.
right.
So now is the time, folks. Now is the time. But
Yeah.
Becky, I really appreciate you taking the time out of your busy day to speak with us about the lending industry and what it takes to get a mortgage. And, I look forward to speaking to you again really soon.
Yeah. Thanks, John.
All
Really
right.
enjoyed it. Hope I helped you out a little bit and learned some stuff today.
Oh, definitely. We appreciate it very much. Oh,
Okay.
before you go, would you like to tell people anyway, does the bank have any type of social channels or anything that people need to be aware of? Anything that you want to tell the folks before you go?
I have mine personally. With Facebook, it's just the
Oh,
facebook.com
okay.
/ Becky. My LinkedIn is Bank with Becky. I have the website to go to my mortgage application is www.bankwithbecky.com. So if you search for that, you'll find me.
Cool. Bankwithbecky.com, folks. Let's get her some. Let's get you some houses, and Becky's gonna get you a mortgage.
That's right.
All right, Becky. Thank you. Thank you again.
All right. Bye.